The senior gold miner ETF is up like 95% this year, GDXJ. These are just enormous moves, and there's no press. Nobody's paying attention to them. When nobody's expecting a recession, then that's when you can have a very nasty surprise and an exaggerated market reaction if that happens. It's a very bizarre situation, David, and right now, all this fake money that's been created has created a lot of economic activity. It's created a lot of froth in the financial markets. But I guess maybe I'm just too old. I think there's going to be a price to pay.
The economy is showing signs of a hidden recession. There are some very important indicators we need to be aware of as not just investors, but people who observe the economy. Consumer sentiment is strong, but spending is down. That's a leading indicator. What should we look at for the fast approaching slowdown that our next guest is warning us about? What should we do for the last quarter of 2025? David Hay joins us once more. He is a co-CIO, or former co-CIO rather, of Evergreen Gavekal. He is the author of the Haymaker Publications, and he's been an industry veteran for more than 4 decades in the investment industry. So David's a regular on my show. It's always a pleasure to have him, even though I'm on vacation this week, which is why I'm not in a suit. But always a pleasure to speak with David in any capacity. Welcome back to the show, David. Good to see you again.
Great to be back, David, and I am happy that you're getting some time off, even though you're working on your vacation. I guess that just is you get the work ethic that wish more people have. It's pretty amazing. So, congratulations on how well your channel is doing, by the way.
Well, I appreciate it. Thank you. I just enjoy speaking with you. So right after this, we're going to go surfing. But this talking to you feels like a nice vacation in itself. So thank you for being back. Let's start with some of the leading indicators you were telling me offline about a potential recession. Now, David, you and I and many of my other guests have been talking about a recession for a long time. So let's just take a step back before we even get to the indicators and the details. A lot of the viewers are wondering, why do we even care about this topic anymore? The topic of a recession has kind of slowed down a bit in terms of interest. It's died down in the media. As you know, stock markets, risk assets, gold have all hit new all-time highs this year. No one's really concerned about an imminent slowdown, but yet here we are. That's our first topic. Why are we talking about this today?
Well, I think you kind of hit the nail on the head there, which is if everybody is expecting a recession, then the impact when one arrives is muted because typically you have depressed asset prices. If there's really a discounting of a looming recession, we don't have that. Now, 2022 is a different story. That's when the expectations went off the charts. It was like a sure thing. I was with the consensus. I thought the odds favored a recession back then, though I did say that it made me uncomfortable to be with the consensus. That was my number one reason for thinking maybe one wouldn't happen. But I did say I thought we'd have a profits recession, industrial recession. We did have both of those, but we haven't had an actual recession. And because a lot of these indicators, these warnings have been flashing orange, yellow, even red for quite a while, there's a tendency to just say, well, it's not going to happen. Kind of the little boy that cried wolf. And so kind of forget the rest of the story that the wolf did eventually show up. But I actually think that if you look at some of this data that's come up, there's more evidence of a true slowdown, which may or may not tip into recession. To be clear, I'm confused, just like the Fed is confused. They've got very different forecasts for the second quarter from the Atlanta Fed versus the St. Louis Fed. There's definitely some positive factors that we'll look at that may prevent a recession. But I do think that the weaker consumers, the lower income, lower net worth consumers are really struggling. I think that's hard to argue with. So we look at the jobs market, and that was a big deal last month. It was a supposed surprise when the jobs numbers for July came in a lot weaker than anticipated. I had done another podcast with one of your esteemed rivals back at the end of July, and he and I both were saying those June numbers, which were superficially strong, just didn't make sense. There were so many flaws in that report, and that's something that I've been on for almost 2 years. That look at the revisions. Don't look at the spontaneously reported jobs numbers, because they're almost always significantly revised lower. And that really hit home with that July release. But it's not just that. I mean, this is a pattern that's been going on. And when we look at this, which is a number of payroll industries that are seeing declines month over month, in terms of their workers, compensation, it looks like a recession. It's really at a level that's only been hit during past recessions. If we look at the 2-month payroll net revisions, same story there. In fact, it's actually worse now than where it's been in some of the past recessions. So it's pretty clear, and we've got some other evidence here that the jobs market is suffering. But the other point is, if you just look at how infrequent recessions have become, it is different. And you got to say, I have to concede that we're not getting recessions as frequently as we used to get them. We've had 34 going back over the last 170 years. We really haven't had a true recession since 2008, 2009. There was that flash crash, back in during COVID, but that was, obviously artificially induced and, quite short-lived. So, just from the standpoint of, are we due for one? Maybe we've taken away the cyclicality of the economy. And certainly we'll talk about a huge factor behind that, which is the federal deficits. We got that coming up. I don't want to spend too much time on it, but seeing other warnings, Las Vegas looks to be struggling. Some experts out there, like David Rosenberg, Doug Cass, the Gabelli team, thinks that Las Vegas is actually a very good leading indicator for the economy. And as we hear from this visual, it was bad in the first 4 months of the year. It's gotten worse since. So that's not. Maybe that's an anomaly, but here's what's not an anomaly, and that's the Chicago National Activity Index. It's got 85 different components. So you can't blow that off and say, well, that's just it's a narrow sample set. It's a very broad sample set. And it's at a 3-month moving, this 3-month moving average is at a downtrend for the first time since November of 22. Remember, of course, that, like I said at the outset, 2022 was a big head fake. Initially, if you remember this, David, in the first 2 quarters of 2022, it looked like a recession. There were actually 2 negative sequential quarters. However, upon revision, it went the other way, was actually revised up. So there was not an official recession in 2022, but there was that profits recession, the industrial recession, which just keeps going on and on and on. So it's more than just some pockets of weakness. And if we look at an area which I think has got huge social implications, the unemployment rate for new entrants, so college grads trying to get a job, is just spiking. And of course, AI is not helping this. I'm sure you've seen some of the reports where companies are reluctant to hire college grads because of AI. They're trying to do as much as they can without actually putting somebody on the payroll. So I think what's fair to say about the economy is that you're not seeing a lot of firings yet, but the hirings have really dried up. So I'd say the jobs market is in a bit of a kind of a fine balanced equilibrium, but it wouldn't take a whole lot of layoffs to start forcing things the wrong way in the jobs market. This trend certainly is the economy's friend, but to be fair, and you were kind of alluding to this, July retail sales were strong. And this is despite the fact that actually, if you listen to Anna Sue from Bloomberg,
Anna Wong from Bloomberg, yes.
It's the University of Michigan. I'm thinking of the wrong person. The University of Michigan Consumer Sentiment Survey, which is the most influential. And I think that is Joanna Sue. But do you know her exact name? Am I mangling it?
So this is the slide, by the way, that you were before we continue. The U.S. unemployment new entrants presented by Bloomberg. Huge spike in new entrants not being able to find a job. And right now we don't have a pandemic locking down the entire country's economy. What does this huge spike signify in terms of the sentiment in the labor force and what consumers are able to spend going forward? So first of all, maybe we can explain why this is happening.
Well, I think it's what I said earlier, that businesses are, there's a tremendous amount of uncertainty. All the uncertainty readings are off the charts. There's been so many changes to the rules of the game that, businesses, when they face that type of it's a black hole. It's just unknown. And so they have a tendency to kind of freeze. They don't fire people. They don't hire people. And I think that's kind of what we're at. And, maybe you could say, well, I think all of a sudden there's going to be a surge in hiring as confidence gets better. And maybe that's why this is just a slowdown as opposed to an actual recession. But as I say, a lot of these things you look at, the leading economic indicators are called the leading economic indicators for a reason. And they've been down for almost, I think it's actually now over 2 years. They've been a long, long downtrend, one of the worst downtrends ever. But as I said, that, you look at some of the consumer spending numbers look to be holding up pretty well. Now, could that be, like car sales? So there's the EV tax credit that's going away. So EV sales have had a surge, even though their trend is not really very favorable. That's a whole other story, but in different podcasts, we'll talk about that. Uh, so you also have the just regular car sales. Forgetting EVs that are also strong as you're trying to get ahead of tariffs. So it's really hard. We've never seen a situation like this where there's this, and these are major factors that are unlike anything we've ever encountered. So it's really hard, I think, to get a handle on what's happening with the economy. But I think getting back to the kind of the key point is when nobody's expecting a recession, then that's when you can have a very nasty surprise and an exaggerated market reaction if that happens. We'll talk about housing because I think housing is a big part of the economy. I mean, you can say, well, housing, home builders themselves are a rather narrow slice of it, but it has so many sub-industries that relate to it. And I think we've got a housing bear market of really significant proportions that's unfolding. And if you look at permits, both are down 20 starts and permits are down over 20% year over year. And permits lead. You can see they are looking extremely recessionary. We know affordability is terrible, but here's what's really fascinating. And I'm not even sure you know this. For the first time ever, new home prices are now significantly cheaper than existing home prices. Now, there was a brief time in 2005 where they kind of converged. You're going to see this on this visual, but now it's like $40,000 difference. So a new home is $40,000 cheaper than an existing home. Again, your esteemed competitor had Melody Wright on. She's a leading housing expert, and she said that it's actually more like 80,000 because the official prices that the builders are receiving or reporting don't include some of these special incentives that they're using to get their homes sold, like buying down mortgages or free appliances and other incentives like that. So if she's right, it's really, let's say 435,000 for a median existing home versus 355 for a median new home. It's remarkable. And I think that's what's telling us where the market needs to be to actually move homes. So I think you're going to see existing home prices come under a lot more pressure than is popularly believed. And could that have significant implications, say for the banking industry? Don't know. I don't think we're going to get the same kind of banking crisis that we had back in 08, 09. But there are risks there that I think are underappreciated. Then if we look at, this is pretty amazing when you look at the cohort that's buying homes, how much of these home purchases are happening with the boomers or even the silent generation. So you're basically looking at almost half of the home buying that goes on by the old folks. And, one of the, actually listen to Ivy Zellman. She's another expert on the housing industry, and she's very concerned about this kind of aging out of the home market by people my age. As we get into our 70s and 80s and we get these big homes that we really don't need anymore. And, who's going to buy those? Who can afford to buy those? And I just think that this housing adjustment that's coming is going to be a bit challenging. We are seeing new home sales breaking out to multi-year highs. So if this was a stock chart, it would look pretty bullish. Same thing with existing. This one isn't as clear. It's more at a critical support level, or resistance level, I should say. But it does look like it is going to be penetrated. I have actually very little doubt that that's going to get penetrated to the upside quite decisively. If we look at combined, new and existing, clearly a series of higher highs and also breaking out to a multi-year new high. So I don't see in fact, what's amazing, David, is the home builders, XHB, which is the home building ETF, is very close to its all-time high with these statistics. And, that's not even really getting into the affordability issue that is just atrocious. I don't know if I don't have, I'll just throw it out there very quickly that Ivy Zellman made the point that the median home price for the median wage is at where it was in 1981, and that's when the mortgage rate was 16%. I mean, the bottom line is homes are about as unaffordable as they've ever been, with very few exceptions. Now, what this does show us is that a lot of this, kind of like the stock market, is because of the depreciation of the dollar. And if you'd actually had, let's say you were wise enough as a young person, and maybe you had wealthy parents or grandparents who were putting money aside for you in gold coins 20, 25 years ago, you'd actually, the home would be cheaper in terms of gold than it was 10 years ago. Yes. And of course, if it was in Bitcoin, if you had Bitcoin, it was drastically cheaper. So some of this is the money illusion caused by the fiat currency, the US dollar being in such a bear market, not necessarily relative to other currencies, though we'll talk about that coming up, but relative to what it can buy. What's really been keeping things going has been this tremendous amount of liquidity that's been floating through coursing through the financial system globally, not just in the United States. Global money supply was recently growing at 12%. And in the U.S., it's about 4%. So maybe that's why, as we'll see, these international markets are really starting to beat the pants off the U.S. For Darius Dale, 42 macro, he sees global liquidity slowed pretty dramatically from 11 to 15% to 4%. And I actually was surprised when I listened to his recent video how bearish he's become on the economy. He's pretty famous for being bullish on the economy, bullish on stocks. With some tactical shifts, he got pretty defensive earlier in the year. Anyway, he thinks that we're in a new paradigm where you're going to have such tremendous liquidity created by the government, and we can talk about this in a bit more detail coming up. I think stablecoins are particularly fascinating in that regard, but that the risk assets can continue to be well bid. But he is pretty defensive on the economy currently, and that did surprise me. But we're always hearing that there's this mountain of cash out there. Speaking of liquidity, but it really doesn't look like it. This is B of A's, trillions of dollars that they have in their private client or collective portfolios. So that's actually quite low. Fund manager also have low cash levels. So the Treasury Secretary, Scott Bessent, wants to see 2.7 trillion go into stablecoins. Why does he want to do that? And the reason he wants to do that is because that is extremely low cost financing for the U.S. government, particularly if they can drive short-term interest rates down. Right now, it's costing 4% for the government to raise money through T-bills. But if they get what they want, which I think is a big part of this liquidity matrix that we're looking at, we're going to see much lower interest rates, even though inflation is still running above the Fed's target. But they clearly want to do something with the stablecoin market, which could actually pull a lot of money. This is actually courtesy of Luke Groman. I think this is a very interesting point to pull money from the Eurodollar market. So there's $11 trillion over in Europe in dollars, but they're outside of the U.S. banking system. So they're uninsured, but they're viewed as being almost like a de facto obligation of the government. But it sounds pretty clear that they want to get that money back to the U.S. and in something which either pays no interest or a very low interest rate. So there's still this positive liquidity cycle that we're in, which is supportive to the market. It's supportive to asset prices. I was listening to Michael Howell, who have you ever had him on your show, David? Michael Howell?
Michael Howell, I don't recall.
He's considered to be the foremost expert on global liquidity, and he's very, very erudite, very articulate, and he does these long wave studies of liquidity cycles. And at this point, it's still positive, although it does look to be getting late in this particular cycle. But he said at this point, you really want to be looking at commodities. He's also thinking that China, which has already done a major stimulus, 1.5 trillion of stimulus, is going to do another 1.5 trillion. So there's a very tight correlation between commodity prices, which are already starting to really to move. It's kind of depends on which one, but certainly the precious metals have been. We'll talk more about this coming up, but clearly hard assets should be winners with all this free flowing liquidity that we've got. And of course, where has it been more free flowing than from the federal government? It's just unbelievable the amount of stimulus that continues to come in. We had the Doge thing. There were fears that there's going to be this massive spending cut, which, of course, it turned out to be just a drop in the bucket. Through the first 10 months of this fiscal year, the federal government's fiscal year ends in September. For the first 10 months, it's actually up. The deficit's up 7.4%. Interest to loans is estimated to hit 1.2 trillion more than defense spending. So this has been, I think, the number one reason we haven't had a recession, because we've been running these $2 trillion deficits for several years, even after COVID. So all that stimulus makes it very, very difficult for the economy to slow down. And there was a belief that early in Trump's term, he would do what Milei did in Argentina and really bite the bullet. And they were making a lot of noises about that. But then clearly when the markets had their big riot back in the late winter, early spring, the Trump administration basically reversed gears in a big way. So they seem to be going full on for growth right now, run the economy hot, get interest rates down, even with the inflation well above the Fed's target. So there's just no sign of fiscal drag. And this gets to some of the quotes from Bessent here recently about what he wants to do with stablecoins. And I think if you're a Bitcoin bull, you probably go, yeah, this is great. We want to see these stablecoins, get 2.7 trillion in them. I think there's 400 or 500 billion in right now. It could be a little bit. It might be a little less than that. Tether's the number one, and what circles the other. But they could. Well, for one thing, I think the government's unlikely to let those guys continue to make the kind of money that they're making right now. It's just a gold mine for these guys when they're paying nothing. As you're probably aware, David, if you have an account with Tether in stablecoin, you don't get any interest. So they take your money, just turn around and buy treasuries. They're making 4% with no risk. And, their overhead is almost non-existent. So I've heard rumors that they're one of the most profitable. If they ever disclose their financials, they've never had an audit. It's Tether's quite the story. But my point is, I think the U.S. government's going to try to disintermediate them, try to get them out of there and actually control the stablecoin market and capture that, that free money. So where's that money going to come from? I do think it makes sense that the euro dollar market is the likely target. And a lot of folks I've listened to over the years think the euro dollar market is very important. So if there's a major exodus of capital out of that, could it be destabilizing? It could. I don't know what the implications are. This is really something I've just started really thinking about, thanks to Luke Roman here recently. But I think it could be a big deal. And I don't think most people are talking about it or thinking about it. We look at commodities, as I think we flagged a breakout last year when gold broke above 2,000. And then this year, silver, we were pounding the table on silver, and it did break a series of breaks.
Okay, let's just back up for a minute, David. So you were talking about how you think there's more room to go for silver. Let's talk about the precious metals right now. Gold and silver. Today, as we're speaking on the 3rd of September, gold has reached yet a new all-time high above $3,600. $3,635 is the latest price. Unprecedented level. This comes as both stocks and Bitcoin have also risen. I wonder how much of this is just anticipation for what the Fed's about to do in a couple of weeks, which is potentially lower rates. But I'll let you comment on why gold in particular has been just outperforming. It's nearing 4,000. I mean, that's the next level people are talking about now.
Right. And as you remember, we actually brought up highlighted the breakout that gold made early last year when it went above 2,000. We thought that was very decisive and was going to lead to much higher gold prices. Frankly, I didn't think they'd go up as much as they did. But what's been a huge factor driving gold prices has been central bank accumulation. So what's happening is basically these big foreign banks, government sovereign banks, have been buying gold instead of treasuries. So gold has become the reserve, not the reserve currency, but the reserve asset of choice for these big central banks. Silver hasn't had that driver. But now it did have a critical breakout, which we also highlighted. And we said we thought it was going to keep running. In fact, I used the term coiled spring earlier this year. And it's now, we touched 40 briefly, backed off, and now it's breaking up above 40. And historically, silver does lag gold when gold has these big bull markets, but then it tends to actually kick the afterburners in and outperform. So we think there is further to go for silver and probably for gold. So one of the things with gold is that there is this belief that the federal government wants to revalue gold substantially higher. In fact, Doomberg is out, the famous Doomberg, with a piece saying it could be as high as 20,000. He's not saying it will be, but it could be as high as 20,000. So that the gold that the United States owns, which may be increasing, it could be that there's some big stealth buys going on by some agencies of the federal government. There's huge amounts of gold and silver flowing from London into America. But regardless, there could be this move to mark up gold dramatically and then use that windfall gain that the Treasury would have with their existing gold reserves. And maybe these, as I said, that have been added to use that profit to buy back government bonds, or maybe collateralized. You got Judy Shelton talking about having something that I've discussed for quite a while, which is a two-tier bond market, where you have some parts of the Treasury market that are actually backed by gold. and would theoretically have a very, very low interest rate. And that's a big part of what the government's trying to do, is to get these interest rates down drastically one way or the other. And that would be a pretty effective way to do it. But clearly, there's been a major shift in the precious metals market. But we'll talk about some of the other commodities here as well, because there could be better opportunities than some of those that are less well known. But here's one that is getting really no press at all. We talked about this before we started recording, and even you were not aware that they're up this much. GDX, the senior gold miner ETF, is up like 95% this year. GDXJ, the junior gold mining ETF, is up about. These are just enormous moves, and there's no press. Nobody's paying attention to them. Until recently, there's been outflows out of these funds. So lots and lots of catching up to do by these guys. Now, they've had a heck of a run. We're actually going to advise doing a little profit taking, and I think that's a good idea. I'm doing that personally, but just in case that there is this major revision, a major, kind of a step change to the price of gold, even if it's 5,000, 6,000, 7,000, the gold miners would obviously keep running, because their costs really don't go up as the price goes up. So there's tremendous operating leverage. But it's just amazing that they have attracted so little attention. But if you look, this is another warning sign. I would say that you might want to do a little bit of profit harvesting on the gold miners. When you look at the gold miners bullish percentage index, it's just Fred Hickey, who's one of the best gold mining investors on the planet, ran this just this week, pointing out that whenever you've had it at this level before, you've had a pretty sharp correction. So I would say for those few people that listen to us and did buy into this area, take 20, 30% off the table. Silver, you can see the big breakout here, and this is what we were talking about earlier in the year. And
take 20%. Sorry, take 20% off the table for gold miners. Is that what you're saying?
Yep, 20 to 30% off of for your gold miners at this point, which means you still have a lot of exposure. But I just don't think you want to be greedy. I mean, you look at these charts, and they are very, very extended. And then the bullish percentage index we just looked at, that's a pretty good warning sign too. So silver, I think, is, if you wanted to play and stay involved with, I think, some of the silver miners, First Majestic is one of my favorites, and it looks good technically. So maybe it's a time to redeploy, cash in a little bit of gold and put it in some of the other commodities that have lagged. We'll look at some other ones as well. And this is just the index itself, the CRB. And you can see that it really has been in quite a downtrend since 2022. So that's this far left little mountain here. That was the invasion of Ukraine when a lot of commodities went ballistic. And then the air has been coming out. And now it does seem like there is an attempted breakout above the resistance that goes back to 2022 toward later in 2022. So I do think that commodities in general are a very good place to be when you've got this kind of liquidity around the world, and where you've got the Trump administration so intent on weakening the dollar, and they want to see the dollar down a lot, which is very pro-commodities. They're trying to drive interest rates down a lot, which is pro-commodities, and they're also interfering with dependence, which is, smacks of inflationary maneuvering. So, excuse me, other commodities that are worth a look. Copper has come down hard. You've got quite low supply. Copper, you may know this, David. Copper spiked to $6, broke out above $5, which had been the prior resistance, pulled all the way back down to $4.40, something like that. Looks like it's stabilizing there. But pretty much with all these commodities, we're looking at constricted supplies and rapidly increasing demand. That's even more true with the uranium. We've played the uranium ETF very well, as I think you might know. When it's been up, we've suggested taking some profits. And then when it got hit, which it did even this summer, we advised coming back in, and now it's running again. And of course, oil and natural gas, they're very out of favor. And yet, this whole AI boom, as I heard Stephanie Pomboy say recently, if you love AI, you got to love energy, because the AI boom is extremely energy intensive. Yet you've got oil trading basically at its cost of production in the United States, around 65. And natural gas is trading in the kind of 260, 270 range currently. And, in Europe, it trades more like for $9 to $10 per million British thermal units. So anyway, energy I will see some more data coming up here. I think it's one of the great opportunities. We touted platinum earlier in the year at 1,000. It's up 36%. It may be, maybe you don't want to chase that, but again, very attractive supply demand setup. But Valterra is we be leading platinum miners, and that's one you can buy. The symbol is ANGPY, and I think that one's got tremendous upside. So what you typically see with these things is the metals move, the miners kind of lag, and then they take off. And I think that's the situation that we're looking at with platinum.
David, let's take a look at the stock markets and bond markets before we close off. This is an article from CNBC. Let me just share my screen here. We were talking about this earlier. The jobs numbers looking weaker, and the jobs openings in particular being very, very weak. It's now job openings now ticked down to levels rarely seen since the pandemic. Now, according to economists quoted in this article, this is a turning point for the labor market. This is yet another data point underscoring how this labor market is frozen, and it's difficult for anyone to get a job right now. The point I'm trying to make, David, is if this is a turning point for the labor market, when can we expect a turning point, or what can trigger a turning point for the markets? No one's really talking about turning points for stock markets and risk assets right now. As I pointed to earlier, stock markets as well as gold have been reaching new all-time highs ahead of the Fed meeting in September. And so I wonder what you as an investor are doing right now with all this information. Is that kind of the broad question I'm asking? Besides commodities that we just talked about, if somebody were to think about either rotating capital or get into the markets now, what should they do?
Well, I'm obviously giving you some ideas here that I think make sense, but I think what doesn't make sense is the traditional reaction. So normally, let's just assume that the consensus is wrong and we do get a recession. And I'm not saying that's going to happen, but as we talked about earlier, the problem is that it's so unexpected currently. And yet there's an awful lot of data out there that is supportive of a downturn coming relatively soon. So if it does happen, some people call it the Pavlovian response, is to buy long-term treasuries. But and they could work for a short period of time, and probably would. But you look at what's going on with bond markets around the world, and these yields are actually going up on the very long end, even with weak economic data. I just saw a chart, I think it was from Luke Roman once again, that if you look at countries where industrial production is falling, which is quite a few of them, long-term yields are rising. That's a classic scenario that used to happen in emerging markets only. And it's telling you that there's fear in the bond market that the central banks of these countries they're not the inflation stewards or inflation hawks that they once were. So what you're getting in a situation is basically fiscal dominance, where the bond markets are being viewed as a financing vehicle for the governments. And even if that creates some inflation, if that creates some disruption, so be it. And you're going to have the Fed intervening, the Treasury intervening, using yield curve control, as the U.S. did after World War II, to suppress those interest rates. It's a very bizarre situation, David. And right now, all this fake money that's been created has created a lot of economic activity. It's created a lot of froth in the financial markets. But I guess maybe I'm just too old. I think there's going to be a price to pay. And I keep looking at how do you hedge yourself if you're an investor? And I don't think you hedge yourself with the Magnificent Seven. I don't think you hedge yourself with long-term treasuries. I think some of these things that are off the radar of most investors, but clearly benefit from the way things are trending, or how you want to position your portfolio. And frankly, a lot of these are working. I mean, gold miners up 95%. I'd call that a win.
So let's say the Fed doesn't cut as much as anticipated this year. Would that move markets? Would that move the needle? Or is fiscal policy more important right now?
It might help. I think what would not be as well received would be a series of aggressive rate cuts, as opposed to kind of a one and done or a two and done. Because I think that would indicate, that's part of the history of the Fed's rate easing cycles, is that they ease kind of slowly, methodically, that's kind of bullish. If they ease frantically, like they did in 2000, 2002, and 2008, 2009, actually starting 2007, that's bearish, because they're aware that there's a problem going on. And also, with this inflation being a lot stickier than what we were led to believe, a major easing cycle, when you got inflation running at 3 and wage inflation is still running north of 4, that would be a recipe for, really a 1970s kind of persistent inflation outbreak. And what did really well in the 70s? Commodities. What did very poorly in the 70s? Stocks and bonds. Now, I don't know if we have time to look at any visuals on the stock market, but I think you got to be, if you're just looking at this objectively, you got to say there's a lot of excesses, a lot of speculative over enthusiasm. What Greenspan called it irrational exuberance back in 1996, and it's really irrational right now.
Well, yeah, by all means. And I'd like to talk about the dollar as well. The dollar has been falling all year, 2025. It's just been a weak year for the dollar. I wonder if this is a pivotal point for not just the labor market, but also the U.S. dollar. Are we seeing the beginning of an uptrend anytime soon?
So here's the dollar index. And to me, this looks like a pretty important break. So this is, we think 3-year either support or resistance is important. This is 5 years. The longer it is, the more important it is. So this is, I think, a sign that the dollar is in a structural downtrend, and it's also overvalued. And beyond that, you have an administration that wants to get the dollar down significantly. So that's why I think you should be looking at things that benefit from a weaker dollar. Why fight it? We've seen how these trends, once they get in place, really, they last for years and they go further than you think. So there's a lot of investment sectors and asset classes that do well in a weak dollar environment, but they're not the ones that have done well over the last 10 years. So we talked about commodities plenty, so I won't go more into that. But if you look at some of these emerging markets, maybe, do you know the number one performing market this year in U.S. dollars is Brazil? Not many people know that. It's up 33% or so. And that market is still only trading for, like 8-9 times earnings. If you look at some of these emerging market bonds and bond funds, one of our favorites is EDD, the Morgan Stanley Domestic Emerging Market Bond Fund, which yields 9%. And I've got a chart here at the end. It's just a thing of beauty. I'll skip to that so you can see what I'm talking about. And by the way, if you look at one of their holdings is Brazilian bonds. Brazilian bonds yield 14%. Their inflation rate is about 5%. So it's about a 9% real return. And that's like what we had with here in America under Paul Volcker. So here's the chart of EDD, which you can see it's been in this range for the last several years, but it's clearly breaking out above prior resistance, and it yields 9%. And that's a name that your viewers can easily buy. So there's definitely opportunities out there, but I think you have to think differently and really just acknowledge the environment that we're in, which is going to be higher inflation and a weaker dollar. And that isn't to say that if you can't have a recession. If you have a recession, that's going to bring interest rates down. It's going to bring inflation, but it's also going to bring a policy response that's likely to be even more inflationary. So any bond rallies that you get, I think, are to be traded, to be rented, not owned, as they like to say on Wall Street.
Is the yield curve going to continue to steepen, David?
Absolutely. That's a great point. I'm glad you brought that up, because I think that is going to happen, is a steeper yield curve. And there are areas where you can benefit from a steeper yield curve. One of the ones that we've been writing up is the mortgage rates, the M rates. So there is an ETF of those, but there's my favorite individual play there is AGNC, which yields about 4 cycles. They actually tend to raise their dividends, so it could be paying more than 14% over the next 2 to 3 years. So yes, great point to bring up. Thank you, David.
Okay, excellent. So finally, let's say asset allocation. If we were to position ourselves into 2026, what would you favor? What would you disfavor right now?
I'm not a fan of the long-term bond market, as I mentioned to you. And yet I realize that there's a lot of negativity on it right now. There could be a rally. So I wouldn't say, don't preclude that possibility. That could definitely happen. But if it happens, don't stay there too long. In other words, if you get a decline in the 10-year from 430 to 350, take your money and run. But in general, I think if you're looking for yield, you want to look at ideas like this or at some of the midstream energy names. We love Enterprise Products, which yields 7.5%. They raise their dividend or distribution almost every quarter, certainly every year, only trading for about 11 times earnings. That's likely to be, I think that's going to beat the pants off the stock market over the balance of the decade. So I would be allocated toward things that benefit from the weaker dollar, benefit from the steeper yield curve. I'd be avoiding those that are counting on a sustainable decline in long-term interest rates, I think there's really a problem brewing with these bond markets around the world. It's not getting very much press. So I think you just don't rely on the traditional 60-40 portfolio, 60%, large cap U.S. stocks and 40% long-term U.S. Treasuries or a laddered portfolio. The short end should be fine, but the unfortunate part of it is that this T-bill and chill thing that's worked pretty well for the last few years. I mean, if the Trump administration gets what they want, and I think they will, that 4% is more likely to go to 1 to 2, which gets to your whole point about how do you play a steepening yield curve.
Okay, I understand. David, excellent. Any other closing thoughts on trades that we've missed so far? Before we go, we've talked about commodities at length, indicators for equity drawdowns or capital rotation. We've talked about bonds. We've talked about real estate. We've mentioned. I think investors really just want to know what to do right now, given so many conflicting economic data, some of which we've addressed today. This looks like a pivotal time for not just the economy, but also for markets. The Fed looks like they're about to cut rates. And like we talked about earlier, the labor market is showing crack after crack, month after month. Any other trade ideas that may point to a pivot?
Well, I would just say, again, with that labor market, to be fair, realize that, yes, the hiring is really drying up, but there hasn't been an explosion of firing. So I think that's something to really watch is what happens with layoffs. And so for right now, I'd say it's not a terrifying jobs market. It's just something that looks a little bit worrisome. But, I think look at Buffett. He's got $340 billion in cash. So having even if you know that your rate's likely to go down on your cash, you're not going to lose money on it. And there's this is kind of an environment. Plus, we're in the time of the year when the market often hits an air pocket. So it'd be nice to have cash on the sidelines. And I've given you some ideas where you might want to be doing some profit harvesting. I think particularly some of these momentum stocks in the U.S. market that are just off the charts in terms of valuation. Cashing in some of those gains would be advisable. And just, putting that into cash and just, I'd say be humble. And, I think right now, unfortunately, Buffett's always saying you want to be greedy when others are fearful and fearful when others are greedy. Well, there's a lot of greed in the market right now. So I think you would be on the fearful side of things and realize, as I said earlier, this is a set of circumstances we've never seen before. And whether it's me or anybody, even Warren Buffett, he's never seen anything like this. So, invest accordingly, which I think means invest and carefully.
Okay, excellent. Let's close it here, David. Tell us where we can find you, read your work, and get more ideas from you.
Well, we're on Substack, so you can find Haymaker at Substack. I think maybe an underscore in there somewhere, but we should be really easy to find there. And we do put out a daily that is, even if you're not a paying subscriber, of course, we really would like to see more paying subscribers like anybody. But we do put out a fair amount of content that is free. There's a paywall that, really protects our best ideas, and particularly the trade-specific ideas, which we generate a lot of those. And we have kind of a focus on yield, unlike most of our competitors. So, and I think, frankly, a lot of your listeners, if they're anywhere in my age group, yield should be your number one objective, and along with preservation of capital. So I think we could be a very good resource for people that do need cash flow to live on.
Yeah, absolutely. All right. Fantastic. Thank you. And make sure to follow David Hay on his Substack down below. We'll talk next time, David. I appreciate you coming on this week. Take care.
Thank you, David. Enjoy your vacation. Get some time off now.
I will. Appreciate it. And thank you for watching. Don't forget to like and subscribe.